Welcome to the Deep Dive. We sift through the noise, stack up the sources, and really try to extract those crucial nuggets of knowledge. Today, we're doing something a little different, diving into a fascinating piece of source material. It's actually a voiceover script for a YouTube video called AI Market News by LM. Our mission is to unpack its market summary, its macroeconomic insights, geopolitical observations, basically give you a concise, structured understanding of the current financial landscape, but filtered through our human curiosity. Now, this source, being a script for an AI-generated video, it actually starts with its own very distinct introduction and a very specific disclaimer. What's particularly striking about how it kicks things off, especially with that AI Market News by LM disclaimer right there at the top.
Well, it's immediately clear this isn't your typical human read news, right? The disclaimer, right at the beginning, it states the audio is automatically generated by NotebookLM, an AI-powered tool, and crucially that it does not provide investment or trading advice. Right. So for us, this immediately brings up the question, how do we critically engage with financial commentary when it's delivered by AI? Particularly when the AI itself explicitly warns about potential errors. It's a powerful reminder, really, to always consider the source of your information and how that might influence its value.
That's a really vital starting point. Okay, so let's unpack the content itself. We're looking at market data from Friday, August 29, 2025. What's the immediate snapshot for the major U.S. equity markets? Are we seeing, broad-based strength here?
The immediate picture for U.S. equities is certainly bullish. They closed at fresh record highs. The S&P 500 notably surpassed 6,500. It closed at 6,501.86, which is a gain of 0.32%. The NASDAQ also jumped 0.53% to 21,705.16, and the Dow Jones was up 0.16% at 45,636.90. So positive headlines.
Okay.
However, beneath those headline numbers, there's an interesting detail. The equal-weighted S&P 500 actually closed marginally in the red. Yeah, this suggests that the Magnificent Seven big tech names are still doing much of the heavy lifting rather than seeing a widespread surge across the entire market. So for you, this means looking beyond just the overall index number to really understand the underlying health.
Right, that's a critical distinction. So the S&P 500 is hitting records, but the market's underlying breadth isn't compelling, as one source put it. That feels like a bit of a contradiction. And even NVIDIA, a star performer, a bellwether for the whole AI trade, was a laggard today. What's the sentiment around this divergence, especially with these whispers of AI doubt sort of creeping in?
It's a fascinating dynamic, isn't it? There's still a strong consensus, among many commentators that the AI boom is just starting, that it's the new electricity, but they also acknowledge it's not exactly a linear path upwards. NVIDIA, despite its really robust growth, saw its forecast disappoint some. It suffered from what one source called astronomical expectations. It was down about 0.79% on the day, though it did pair earlier losses. So this really begs the question, is the market just digesting capacity after a period of really intense capital spending in AI infrastructure? Or is this just a momentary pause in what might be a much longer boom?
Right.
Our sources offer a couple of perspectives. Some optimists see us only in maybe the sixth inning of the AI infrastructure build-out, suggesting there's still significant room for growth. But others are questioning if maybe the market has simply overshot, with demand needing to catch up to the massive capital spending we've already seen. It really highlights the non-linear nature of innovation and market cycles.
That's a really important nuance for anyone following the tech sector closely. Now, let's zoom out a bit to the currency markets. Specifically, for you tracking global movements, what's the picture for USD and USD JPY? This is as of Friday, August 29, 2025, U.S. time.
Okay, looking at the data, USD was at 1.1667. That's down 0.14%, indicating a softer euro against the dollar. Conversely, USD JPY was at 147.18, up 0.17%. The Japanese yen actually saw some interesting volatility. It strengthened quite a bit overnight, reaching around 140 earlier, but then later consolidated around that 147 mark against the US dollar. Now, this movement comes amidst growing expectations of a potential 25 basis point rate hike by the Bank of Japan in October. For investors, this is a truly significant development because it could signal a long-awaited shift away from decades of ultra-dovish policy that could potentially impact global capital flows quite significantly as the yen maybe finds its footing.
A potential shift for the BOJ, definitely something to keep an eye on. Okay, what about commodities and bonds? Any notable shifts there that help paint a broader economic picture?
Certainly. Crude oil, WTI was at 64.24, down about 0.5%, 0.56%. Brent oil at 67.61, also down 0.54%. And Brent is actually heading for a monthly loss amid concerns about a looming glut.
Okay.
Gold was also slightly down at 3,465.60. In the bond market, the 10-year U.S. Treasury yield was at 4.221, slightly up. But overall, the U.S. yield curve is steepening.
Right.
And this raises an intriguing point. Why are investors asking for a premium to own long-term bonds, even when the U.S. economy seems to be performing pretty well? It seems to reflect growing concerns over diverging fiscal and monetary policies globally, where government spending stays high, even as central banks try to tame inflation. This divergence, it signals investor unease about future economic stability and, frankly, debt levels.
That's a fascinating insight on the bond market, suggesting investors are wary of that global policy divergence. And speaking of policy, all eyes in the macroeconomic world are certainly glued to the U.S. inflation data due out today, August 29th, 8:30 a.m. U.S. Eastern Time. What are the expectations from our sources for the core PCE and the PCE price index reports?
Well, the consensus from the prepared resources is that the July core PCE price index month over month is forecast at 0.3%, and the headline PCE price index month over month at 0.2%. Year over year, core PCE is expected at 2.8% and headline PCE at 2.6%. The general feeling, the sentiment, is that this data will likely confirm the, quote, persistence of price pressures.
Right.
What's important for you to note, though, is that it's considered probably too early for those recent tariffs to show up significantly in these numbers. Instead, we should really pay close attention to services inflation, which remains strong, largely driven by that tight labor market, still a persistent headache for the Fed.
So persistent price pressure is expected. Okay, what does this all mean for the Federal Reserve and the likelihood of rate cuts? The CME FedWatch tool, which is, a key resource for tracking these market probabilities, has been buzzing. What's it saying?
The CME FedWatch tool indicates that a 25 basis point rate cut in September for that FOMC meeting on September 17th is largely, baked in. About an 80% probability according to commentary. We've even seen Fed Governor Christopher Waller being quite a vocal advocate for cuts, even suggesting more beyond September. But this creates a tension, right? Because Q2 GDP was just revised upwards to a pretty healthy 3.3% annualized pace, and corporate profits look strong. So, does the economy truly need aggressive cuts, as one news commentary asked? This is really where market expectations and the actual economic data might be on a bit of a collision course. It leaves you wondering how much runway the Fed actually has for easing.
Yeah, that's a key tension. And beyond the numbers, there's this extraordinary storyline unfolding around Fed independence. Fed Governor Lisa Cook suing President Trump to block her removal. I mean, this isn't just a political spat. It has real potential implications for financial markets. What's the absolute latest on this high-stakes legal battle?
This is truly unprecedented territory. Lisa Cook's lawyers are arguing that the Federal Reserve Act has a for-cause removal restriction, and they're saying the president hasn't satisfied that standard. A hearing is actually scheduled for today, August 29th, at 10:00 a.m. U.S. Eastern Time in a D.C. District Court. Her team is seeking a temporary restraining order, basically to allow her to participate in that critical September FOMC meeting.
Wow.
Yeah, this legal challenge, as various news commentaries highlight, is seen as a critical test of central bank independence. If the executive branch were to gain more sway over the Fed, it could really spook the markets by undermining confidence in, unbiased monetary policy decisions. It just introduces a significant and frankly unusual layer of political uncertainty into the whole financial landscape.
That's a huge potential factor to watch, absolutely. Let's broaden our view again to global trade and geopolitics. Tariffs have been a recurring theme, and the U.S. de minimis exemption is expiring. Now, for those less familiar, this is the threshold below which imported goods are exempt from duties. It's changing dramatically from $800 down to just $100. So what are the real-world implications of this shift?
Right, this change, it takes effect at midnight tonight, August 29th. It means packages under $100 will now face duties, down from that much higher $800 limit. Apparently, it's already caused disruption for some shipping companies and has led small businesses in Asia to actually consider pulling out of the U.S. market, according to some news commentary. Yeah. Now, while for some large e-commerce platforms like Shopify, the impact might be negligible, they say it affects only maybe 3 to 4% of their gross merchandise volume. Individual consumers, like you, could face unexpected higher bills on imported goods. Bloomberg reported on this. The big question here is, will this measure actually serve its intended purpose for the government, or could it inadvertently accelerate a broader sort of pull out of the U.S. as an economic market by global sellers just looking to avoid the increased complexity and costs?
So tighter borders for smaller imports, potentially impacting consumers. But in somewhat brighter news for trade, the European Union has adopted draft regulations to remove tariffs on U.S. industrial goods. What does this signal for U.S.-EU trade relations, especially in a world that's been grappling with protectionism?
Well, this move by the EU is definitely a significant step towards realizing a trade agreement with Washington. It's expected to pave the way for the U.S. to lower its tariffs on European cars and auto parts, potentially down for 15% from the current 27.5%. So this signals that de-escalation between the U.S. and European Union is definitely on track, as one news commentary source highlighted. That meets hopes in both markets. However, it's probably not a complete all clear. The sources remind us that political figures like President Trump could still pivot back to other issues, like digital services taxes, maybe. It suggests that potential tariff threats might not entirely disappear. So it's a positive step, yes, but the path to fully frictionless trade is still a bit winding.
A step in the right direction, but with caveats. Got it. Finally, let's turn our attention to the SKO Summit happening this weekend. This is a major diplomatic event in Beijing. It's bringing together leaders like Xi Jinping, Vladimir Putin, Narendra Modi. I mean, this feels like a powerful convergence of global players. What's the big takeaway from this gathering for those of us tracking the global balance of power?
Yeah, this SKO Summit, the Shanghai Cooperation Organization, is expected to be the biggest on record. It's hosting 10 member nations and 16 observers or partners. Together, they represent half the world's population and, importantly, significant energy assets. What's truly fascinating, though, is the apparent rapprochement between China and India. Modi is making his first trip to China in 7 years.
Wow.
And commentary suggests this is largely a byproduct of the U.S. imposing those 50% tariffs on Indian goods, partly due to India's purchases of Russian crude. So the summit is clearly seen as an attempt by China to lead an alternative global geopolitical order, trying to gain credibility as a rival bloc to the world order led by the United States.
Mm-hmm.
For you, this really raises an important question. How will these shifting global alliances, driven maybe more by trade policies and economic pragmatism than pure ideology, reshape the international landscape in the years ahead? It feels like a realignment in progress.
That's a profound thought, and it really touches on almost everything we've discussed today.
Yeah.
Okay, diving into specific industries now, let's circle back to AI. We heard about NVIDIA's performance, but what about other players in the ecosystem? Dell reported earnings after the bell yesterday. What did they tell us?
Right. Dell actually exceeded expectations. They raised their full-year AI server shipment forecast to $20 billion. That's up from $15 billion, a pretty substantial 30% increase.
Yeah.
This suggests that while there might be, those astronomical expectations for some, the fundamental AI build-out, particularly in data centers and server demand, is far from stopping. However, other chip makers like Marvell showed kind of mixed results. It indicates that the benefits of the AI trade aren't really uniform across all tech companies.
Right.
It highlights that this AI boom is complex, it's multifaceted. What we really need to ask now is, as the focus maybe shifts from the big foundational models towards the AI app layer, which companies will prove to have the durability and the product market fit needed to thrive in this evolving landscape? It's not just about the chips anymore. That's a crucial evolution to track. And what's the picture in the retail sector? Especially with that de minimis change we talked about and just varying consumer sentiment impacting everything, we saw Gap and Ulta report earnings.
Yeah, quite a contrast there. Ulta Beauty posted strong results, actually. They beat EPS estimates and significantly bumped up their full-year comparable sales growth guidance to 3.5% So that clearly suggests pretty healthy consumer spending in their segment, beauty.
Right.
However, Gap painted a very different picture. They missed comparable sales expectations and forecasted a major tariff impact on their gross margin, potentially a 2 percentage point hit just for the current quarter.
Ouch. Yeah. And this, combined with comments from, say, Hormel Foods blaming cost for poor performance, suggests that while some consumers are spending, everyone wants value. Companies are clearly struggling with tariff mitigation strategies. The consumer behavior seems really bifurcated. So the question for retailers becomes, how will different brands adapt to these pressures? From premium names like Ulta to, say, value-driven outlet malls like Tanger, which apparently continues to see traffic build. It's a real split.
Fascinating how different segments of retail are experiencing such divergent fortunes right now. Okay, finally, let's turn our attention to China's tech giants. Alibaba and BYD also reported earnings. What are the key takeaways for us from these updates, especially given the broader geopolitical and trade currents we've been discussing?
Well, Alibaba is facing intense competition in the food delivery sector. Its local services group is actually expected to post a $460 million loss for the June quarter. This reflects really aggressive spending just to defend market share there. BYD, on the other hand, the world's biggest EV maker, is expected to report robust profits for the first half, but driven largely by heavy discounts. However, China's own anti-involution campaign, which is basically a government push to curb what it sees as excessive or unhealthy competition, might limit future discounting.
Ah, okay.
And BYD is also trying to expand overseas sales to improve margins, but it faces those geopolitical tensions and trade barriers like Mexico's tariffs against Chinese imported goods. So their global ambitions are clearly constrained by these geopolitical realities. It raises the important question of how Chinese tech and auto companies will navigate this intense domestic competition and increasing global trade barriers while still trying to seek growth in diverse international markets. It's a tough balancing act.
Indeed. Wow, we've covered a tremendous amount of ground today, from record stock highs and shifting currency dynamics to central bank independence battles and complex global trade deals. If you're looking to keep an eye on all these indicators and stay informed on what's coming next, where can you turn for, a reliable roadmap?
Investing.com's economic calendar is actually an excellent resource for tracking upcoming economic events. You can use it to filter by country, by importance, by category. It allows you to monitor key data releases for U.S., European, Asian financial markets as they unfold, all in U.S. time. Keeping an eye on this will definitely help you anticipate market movements and understand the drivers behind them, really helping you stay ahead of the curve.
That was a truly insightful deep dive into a very, very dense stack of information today. It's clear that while, yes, we're seeing record highs in U.S. equities, there are so many underlying complexities and global shifts that make the market far from straightforward. The interplay of AI's promise, central bank decisions, geopolitical maneuvers, it's creating this constantly evolving landscape where the signals are often quite contradictory. So what's a provocative thought to leave you with today?
Well, even as AI-generated news commentary like our source material becomes more prevalent, the real aha moments, the real insights, still seem to come from human curiosity and that critical analysis of the diverse, sometimes conflicting signals the market sends. Your ability to connect those dots, to ask those deeper questions about why and what if, that's going to be your greatest asset in navigating this complex world. And on that note, we'll end our deep dive here. We just encourage you, keep learning, keep asking questions, and keep diving deep into the world around you.